some time, for 8 years. Not that we've been doing this for 8 years, but nonetheless, the fact that we have oil closing last week above $90 a barrel, an intraday trading above $91 a barrel. This, of course, is the first time in close to 8 years that indeed oil has reached these heights. And there's clearly multiple reasons for that, and including the fundamentals of supply and demand, and that seems that we go into a week ahead with an OPEC meeting with the market very, very tight. Let's kick off and welcome Maliha Bengali, founder of MB Commodity Corner. Welcome, Happy New Year, Maliha. Nice to have you back at the table. Your thoughts at a week that in review where it was finally acknowledged by the Fed that rates would be rising. Goldman Sachs have now bedded in an expectation of 5 rate rises this year. Your thoughts on reflection of the week that passed that gave us $90 oil?
Thank you, Sean. Thank you for having us here again. So the Fed basically is, we've always said, played a very sort of reactionary role in the market. They are very backward looking. I think they've come to terms with the fact that the inflation is not transitory. There's a lot of secular inflation. When we get the report in February for January CPI, we'll get a good handle as to what inflation really is doing on a month-to-month basis. But yes, they are now factoring in a much sort of higher interest rate increase. The bond market and rate market actually has been talking about this sort of distress in the market for quite some time, suggesting a Fed policy error. And we've seen the way the bond market has been trading the 2-year, 10-year yield spreads and of that sort. So market coming into this year has pretty much priced in inflation to be higher at the same time while growth is actually plateauing and softening a little bit. All the Fed-induced, COVID stimulus stuff from last year helped, exacerbate all the sort of demand, the growth names in the market. And now the market is sort of in a bit of a stagflation mode where inflation is quite secular and growth is sort of like leveling off. So the market right now is asking the Fed, are they going to actually do the rate increases, or is it just another sort of a Joe warning event? And we think the market will actually force the Fed's hand because they are sort of very backward looking. But once again, they always tighten in a market that's sort of leveling off, and they always increase QE at a time the markets are very buoyant. And that's why you get these sort of exacerbated moves. But the Fed's pretty much in a corner right now. They cannot print more money right now because of the inflation is too high to stimulate the market, and they have to look at rate increases. If they increase rates too fast, the market will collapse. So they are sort of taking a very sort of...
Surely is not 5 rate rises in 1 year now the expectation from only a few months ago where there was expecting to be none? Is that not... How would you define too fast? I mean, this is the critical point. What does overreacting, what does putting on the brakes too hard look like at this point?
So I think you're absolutely right. The market's pricing a lot more aggressive, high interest rates. If we get a lower print in February and March for the Jan-Feb numbers, I think the market actually probably is priced in too much hawkishness. So it's very data dependent. We don't think the Fed will actually go through 5 rate rises. They'll probably do a few. The market will probably have a bit of a collapse, and the Fed's going to go back as they always do. So that's how the market is forcing the Fed's hand. It remains to be seen as to how aggressive they'll be. But I think they're sort of in a hope and wait attitude, hoping that market might settle down before they need to do 5. But it is, you're absolutely right. The market is definitely pricing a lot more of a hawkish scenario. We don't think the year will end up with that many rate rises based on what the data is suggesting for the forward-looking indicators.
Let's welcome our regular Sunday commentator, Christoph Ruhl, Senior Research Scholar at the Center on Global Energy Policy at Columbia University. Christoph, a week again in review in which oil passed through 90, closed on Friday, actually just barely above 90, 90.03, having gone through 91 in earlier trade on Friday. But nonetheless, you're reading on the market from the point of view of fundamentals, i.e. supply and demand tightness versus this sort of activity of the monetary policy. Geopolitics is flickering, of course, out there as well. But fundamental supply and demand tight market versus all of the other noise.
Well, I don't think anybody was really very surprised by the market spiking up. And you saw your $100 question with like 80% of the audience saying, yeah, it may hit it may hit $100 within that year. We are in a very volatile phase. We have the problems, the disruption threat from the Ukraine. Sorry, I have to concentrate today a little bit.
All the gremlins are out today.
The UK threat is already behind us.
The UK is going to invade the Ukraine. Tell Boris Johnson he doesn't know yet.
That would be the distraction some people hope for, right?
Yeah, exactly.
And what we have in oil markets is a situation where spare capacity goes back to normal. Nobody knows what demand is, and which is tense at the moment, no doubt of it. And as you have heard many Sundays before, we would expect this to loosen up a little bit in the spring when the recount of the US translates into higher non-OPEC plus production and when it becomes apparent whether economic growth is strengthening or not. And the signs are all pointing into, number one, global growth slowing and being less than many have hoped for, and not only from China, but now also from the US. Number two, the Fed finally having come around to being forced to react a little bit at least. And number three, also the oil markets are sort of generating supplies and not being in a position where they really want to wreck the boat. On the monetary side, I mean, we do have to pick apart some of these things. Number one, again, we have said this many times here on Sunday, this was a mistake entirely foretold, not only here on Sundays, but also in the public debate in the US. The Fed has been warned many times that this kind of money creation and this kind of negative interest, low interest rates would create inflationary pressures. Number two.
Is it fair to say that this is incompetence? I mean, can you be this bad at, you've got, I don't know how many hundreds of economists they have at the central bank, at the Fed. Could they be that, off the mark?
The key, well, I wouldn't say incompetence, it's that even forecasters, even hard-boiled economists are sometimes caught by wishful thinking. Right? And the key to that surprise is a double one. The key to that surprise was, number one, that the real mystery is why it didn't happen much stronger, much earlier. And number two, so they would have thought whatever the reason was, and there's many which we can discuss if you like, but whatever the key reason was may continue. And so it will not happen immediately or not that strongly. And the second one is political. I mean, this was the beginning of the Biden era. Powell had to be confined. Biden was pushing this huge fiscal stimulus through Congress. At that point, a Federal Reserve chairman who said, hold it because you're creating inflation, would not have been reappointed. Right? Let's put it quite frankly. Now, the second point is there is no this kind of dubious anonymous standoff. You can measure what the market thinks. You can see the forecast and the inflation rate. They're pricing in at the moment between 4 and 5 hikes. Goldman Sachs has decided 1 hike and 5 hikes. What that translates to is 1.25%, because every one of these guys talks about 0.25% per increase. There are the first voices who said it might be 0.5% at some point, so that would bring us to 1.5. Whatever it is, what is important is that the rate of inflation is 7%. If the interest rate goes up even to 1.5%, it's still a hugely negative real interest rate, and therefore still an expansive monetary policy. So don't expect the inflation to disappear very fast, and don't expect the market to crash and burn, because they still have too much money which they need to invest somewhere.
Yeah, it's clearly, Malia, a market that is still going to be massively supported. The balance sheet of the Fed, of course, remains in the, I think, $8 trillion or something to that effect. So even though you stop pumping water into the sponge, so to speak, the sponge remains saturated.
You're absolutely right, which is why the S&P right now is struggling between the 200-day moving average, the 100-day moving average. The market on the index level obviously is down 11% year to date, but the sector rotation is aggressive. You've seen value stocks re-rate because of the inflation factor. You've seen growth stocks de-rate. All the sort of tech level stocks are down about 70 to 80% from the highs back in November. So this aggressive rotation is already being depicted in the market. You're right that until the Fed's balance sheet close to $9 trillion right now,
it's good.
It's not actually going to take the market down once they start tapering the balance sheet. They have these notions that they might have to, but we've seen in the past when they did taper the balance sheet, what happened to the market, 2018, 2019. So Fed really is quite sort of boxed in to a scenario where if they try to tighten too fast, or they do, the market may not be able to take it. But for right now, there is a lot of liquidity. I agree with you. And that is supporting the level on an index on an absolute level.
But Maria, if I may, this rotation which we're seeing, it's true we're seeing that, but that's a good thing. No? The characteristic of a taper is that we don't have this rotation. So I look at this the other way around. I'm amazed how well the market is coping with all this uncertainty. It's just an indicator that, again, there's still too much money, which it's TINA. There's no alternative. So people will continue to invest.
On that, looking at the oil markets in specific at the end of last week, Christoph, we saw record 8-year highs on the backwardation out the 6-month curve. We're talking $6-7. This is a big impact to really accelerate the consumption of inventories. How do you see that playing out and impacting the markets moving forward?
Yeah, this is important, and there's a good article or just a statement on it by Kemp in your collection. So what we should not forget, again, picking it apart, backwardation, for those who don't know, means that the present price, the spot price or prompt price, is higher than the future price. That's the situation we're in, and we have very, very steep decline. It means two things. It obviously means that present demand is very high, or present supply very low. One of them, there's a mismatch, otherwise present price would shoot up. And secondly, it means that there's no incentive to inventory. So nobody is really worried about what happens a year down or a few months down the road in future markets and beyond April in that particular case. And I think this reflects pretty much what we have been saying many times in these discussions here. You have, for a variety of reasons, tight markets right currently and a lot of geopolitical risk and a lot of nervousness. You also have an outlook which is not, exactly pointing at a very, very running out of spare capacity, running down all the inventories, and then having permanent high price levels. You have an outlook where you see supplies coming in, where you see OPEC spare capacity still being there, where you see these temporary geopolitical threats hopefully subsiding, which is an outlook of lower oil prices. And that discrepancy between today and tomorrow also explains why most of the institutional forecasters of oil, so for example, the American EIA, so have still forecast in the mid-70 ranges, and even the investment banks, which tend to be gung-ho, reach from somewhere in the 60s to somewhere in the 80s. Nobody predicts seriously $120 at the moment. And this is what we see in this backwardation. Again, so very high, I would like to rephrase it, very low current supplies, courtesy to OPEC Plus with all sorts of circumstances, and high expected demand. And down the road, expected demand lower and supplies higher, and therefore moderation on the price side. That's what it tells us.
Well, Leah, how do you see the impact or the sort of chicken and egg here of the rising oil price, again, above $91 intraday trade at the high last week, and the central bank, the Fed in particular, facing, although we have the UK central bank meeting this week as well, and they are expected to raise rates again this week in the UK. What the higher oil price, how does that impact or play into Fed decision-making going forward? Because of itself, of course, the higher oil price acts like a rate hike in the sense of its cost on production, cost on company, cost on all things.
You're absolutely right. So this is reminding us a little bit like the market back in 2008, but not entirely, but the market actually was worried about a slowdown and inflation got so high, oil price peaked at $147 a barrel. We think that oil price being this high is actually not very good because the sort of the elastic band is stretching on inflation. It comes to a point where the market snaps, and that sort of hits the oil in the markets as well. Inflation is a huge problem, but until prices fall down, raw material, goods and services, the Fed will have no choice but to raise rates. So something's got to give. Either the markets collapse to a point where the Fed stops tapering, or I think commodity prices eventually at some point the demands will start leaning on the market to the prices down. But for right now, it's a big problem for the Fed because you look at energy prices, gas prices have come down right now, but copper, raw materials, nothing is really easing for the Fed to suggest that even the January Fed numbers will be lower. So that is presented to be a big problem. And eventually that inflation scare that we call it could take the entire market down. There is a risk of that. It could snap.
Christoph, we have the OPEC Plus meeting this week. All of the expectation is, same as it has been, rollover increase to 400,000 barrel a day per month supply agreement that's locked into the OPEC Plus. I thought that they should be thinking of anything else than that at this point?
I think they won't. I think they will go ahead with the program. And again, they will face a situation in which the actual increase is much lower than what is announced. And in the future, increasingly, they will use that as a welcome argument to deflect upcoming criticism along the lines of what Leah just mentioned, that, from the US or from somewhere else, that they are actually increasing inflation. But let me come back to that point, this intersection between oil price and Fed policy or inflation. And let me pick that apart too. Yeah. The oil price is of a dual nature. on the one side, it's a relative price. So that's not inflation. A relative price is one price in relation to other prices, which go up somewhere and go down somewhere. That doesn't need to change the aggregate necessarily. On the other side, oil goes directly and indirectly into almost anything we do. And so it lifts prices general. And secondly, oil price fluctuations tend to be short-lived, whereas inflation is more of a longer-term problem. For that reason, and this is often forgotten, the favorite inflation measure of the Fed is not the CPI, the Consumer Price Index, which includes everything. It's something which is called the core CPI, which is the Consumer Price Index minus oil prices, minus food prices, right? Minus energy prices, I should say, minus food prices. That's what they're looking at. For illustration, the inflation rate is around 7%. The core CPI is around 4.5%, between 4.5% and 5%, I think. Inflation expectations in Europe for next week, when they be announced, will be 5%, and the core inflation about 2.6%. Now, to some extent, of course, you can accuse the Fed and the central banks to sort of sweet talk the situation by redefining the measure. There's some truth to that. But in another respect, it is an overstatement that the oil price alone would create inflation. It can accelerate it and it can make it worse. But if the oil price then starts to come down starting in the spring or so, or calm down somewhere, then it will have the opposite effect. And mind you, what should really matter for policymakers is not the level of inflation only, but whether it rises or falls. As long as it goes up as it currently does, everybody will start asking for more higher wages, lose confidence, plan on higher prices. And you have this spiral developing of which everybody is afraid for good reasons. If it calms down, or even if it stays constant, then that could help. And the oil price is at least as helpful in bringing it down as it can be an accelerator. But it's not the ultimate cause.
Maliha, we also have in the sort of contagion or the consequence of all of this, we got higher interest rates, stronger dollar, higher oil price. All of these things play into the emerging markets, play, at least historically, negative for Asian demand, Asian economic growth. How do you see this somewhat accelerated tightening cycle with the higher dollar, higher oil price playing out in Asia, Asia demand, Asia growth?
So what in China or in Asia and specifically, they also started tightening a lot faster and sooner than the Fed. So the market has been pretty much that China and Asia has been positive in terms of their now tightening, and the Fed's been sort of the other way around, the easing, the Fed's been tightening. I think that sort of played through with the higher dollar, because now the market's finding the rate of change to be a higher dollar. The Fed may be a bit more aggressive, and that would actually hit emerging markets. And we saw markets take a hit last week on China as well as emerging markets. So that is a bit of a bearish indicator. Now, Q1, because of the Asian Olympics and Winter Olympics in Beijing right now, demand for copper, for commodity resources generally has been holding up, and China actually has been boosting projects to boost the infrastructure projects. So the loans they've been published in the last few weeks have actually helped the market. The big question is what happens at the end of Q1? Does the softness in the entire market feed into the Chinese market that actually has been holding a lot better from a demand supply point of view? So if the dollar continues this path of a higher rate, we think that actually could impact the emerging markets, and will actually lean on them as well, not just a relative game, but also from an absolute game.
Let's get the survey question and give everybody a chance also to sort of express some views on this. Will the accelerated Fed tightening of 5 rate hikes, at least that's the forecast by Goldman Sachs, but generally I think the consensus is still around 4. That's still a lot more than was expected. And I think what we've seen in recent months is this acceleration of hawkish approach keeps accelerating. And could this even accelerate further? Where some analysts forecast that even a rate hike at every meeting would be about 7 increases. But nonetheless, will this accelerated Fed tightening in 22 stop oil prices from reaching $100 a barrel? We did ask last week that prices would get to $100. The consensus, as Christoph mentioned earlier, was yes, they would get there in 22. But I'm now asking, could this accelerated tightening derail that? Yes or no? Welcome people's views on that. Christoph, the other big story, of course, last week and will be again next week is all things Ukraine. How do you finish the week? How do you think of this Ukraine crisis now, looking back on what you saw last week and going forward?
I mean, the general contours are unchanged and the uncertainty prevails, but the fact that they are now talking in so many different political and diplomatic channels is probably good news. I think the general story is still one with Russia throwing around its weight, bullying a neighbor, probably initially even without a clear game plan. You know, sometimes you just stoke in the fire and see where the flames come up and where you can capitalize. And the West mustering a response, which I think was surprising in one respect, because this is clearly a new strategy. They, and several newspapers have noted that they were very, very open about everything, about leaking information about the troops movements, leaking information about what they thought Russia were planning next, leaking information about how difficult it was to get Europe and the US aligned, leaking information how the Germans would not play along, all these kind of things in a sort of permanent new way. I hesitate to call it propaganda, but kind of a very transparent openness meant clearly to thwart any kind of Russian thinking or take away the initiative from Russia. That has worked pretty well.
You even had the Ukrainians saying, listen, stop creating so much panic.
Yeah, and that's because presumably the Ukrainians know a thing or two which we don't, which is that this movement or so was really just looking for a victim. And I think we're still in the same situation. With the threat of maximum sanctions, as the Russian calls it, hanging over them, they know that with a little incursion, a little bit here and there, they will not be so maximum. They're very well guarded against them. So they will try to do something just under the level of these maximum sanctions. What will they try to do? What we know, we don't know, but what we do know is what they want. They want the Ukraine to be a vassal state or a very weak state or a failed state. Russia is not a beacon of prosperity and democracy which can attract people around it. Russia is a permanent threat or feels under permanent threat from people rebelling in Belarus, in the Ukraine, in Kazakhstan against these autocratic regimes who have taken from them all the promises from 20, 30 years ago when the Soviet Union collapsed. And to guard against that, they need vassal states or weak states in the immediate neighborhood. That's the goal. So they will try to inflict the damage on Ukraine as much as they possibly can without triggering the nuclear options of being cut off from SWIFT and being cut off from energy. And the level for that is, what they can do is quite high, because the nuclear reaction from the US and Europe is pretty far away, I would say. Something really bad has to happen for them to act like that. Otherwise, the Europeans won't get along.
Maliha, the markets seem to be in a parallel universe to the politicians, because every time you turn on your TV and sort of review the news, the politicians are saying this is a serious crisis. There was headlines over the weekend, this is our Cuban Missile Crisis, a la 1962. The rhetoric politically, this is a major moment for Europe, a possible major fracture. The equity markets and the oil market, one would have to say, is fairly nonchalant about it and getting on with daily business.
I think, Sean, it's all about liquidity. One of the biggest drivers of this market has been liquidity. And then until that actually been withdrawn, we think asset classes won't collapse finally. So you are right, that may be a bit naive to simplifying matters, but the market is really driven by the net aggregate injection of liquidity by central banks, to put it simply.
And look at the Russian stock market and the Ukrainian bonds market if you want to get some cheap stuff. Right. There was an impact.
There's clearly an impact on the margins, but ultimately it doesn't seem. I mean, we also had over the weekend comments from the Chinese foreign minister signaling that the current pathway on Taiwan could lead to. I mean, I think there is a sort of equation here of Ukraine is Russia's Taiwan to China, and the Chinese could be encouraging this moment. Ultimately, it seems to me we're kind of getting into a face-saving exercise. How does Putin back away without having some kind of trophy of significance? That becomes problematic. Let's get the survey result and look to the week ahead for final comments. No, will the accelerated Fed tightening 5 rate hikes in 22 stop oil prices reaching $100 a barrel? This room remains quite bullish. Your own thoughts on that, Christoph, moving forward, given the fundamentals of this market, OPEC, yes, meeting next week, will agree their rollover, but even this market, and everybody knows, they can't even increase by 400,000 barrels.
That's right. And I voted no as well. And last time I voted yes to the $100 as well, because of this time profile which we have right now. It's going to be tense. The Fed hike rates which affect the real economy are way down the road, so they will not coincide. It's the other way around. If we are unlucky, then we have all these things coinciding: very high rates, slowdown in economic growth, lower oil prices, everything coming in the second half, a bad surprise from Chinese growth when they don't loosen up with Omicron, maybe even a bad surprise from the virus front. So it starts, the further you look out, the more darker the horizon gets. And otherwise, I agree with what you just said about if I would have asked what was probably from the department, who knows, the most significant event last week was that little statement of the not so new Chinese ambassador in the US, that there may be a war about Taiwan, which coincided with a fleet of 32 or whatever fighter jets going in there. And I just to finish on that note, because you mentioned Putin and China, I got, just before we started, and that's why I couldn't investigate it, an interview request. And I said, about what? And they said, about an announcement that China and Russia want to have joint expeditions to the moon. Apparently, did you hear that? That must have come through the wires just before we started.
No.
So that would be the
But
kind of thing which increases
the relationship between Moscow and Beijing is finding a lot of alignment. Maliha, your thoughts just closing out a week ahead, trajectory of prices. Are you in the bullish camp? We've got, as we've talked last week, the projections for the year are very diverse. We've got Citi in the 60s average. We've got Goldman above 100. What's your own sense of analysis and outlook?
I think the physical market, the oil market, is very tight over this month and the next month because we have the winter northern hemisphere, we have cold demand, aggregate demand holding in really well. Travel demand still not back at pre-COVID levels, but net demand is holding up. I think after March, when you start getting into the post-winter period, given the macro inflation fears, we might have a bit of cause of concern. But right now, the physical oil market is very supportive, and OPEC Plus is not able to do any more than the usual 400,000 barrel per day increases. And there's questions about spare capacity. But the bigger picture is looking at demand on a 6-month basis, where how does the macro and global economics slowing down affect that demand going forward? And then we have the Omicron fears and everything, of course, as well. But right now, the oil market looks very supportive from a physical demand supply point of view in the short term.
Yeah, as they say, old saying goes, the best cure for high prices is high prices. Can the world absorb $90 oil and moving higher at this economic time as we try to step out of COVID? And the IMF and World Bank forecasting, revising downward expected growth in 2022. There does seem to be a collision course there between those two things, and the geopolitics. If it was to sort of resolve itself, this Ukrainian crisis, how many dollars are we currently seeing in the 90 that would be in the sort of definition of political premium, geopolitical premium? It does seem to be, nonetheless, this is a very tight market with the steep backwardation telling you, get your oil out of inventories and get it sold while you got the price. And so it does fundamentally seem tight. I think one of the things to watch out for going forward on OPEC Plus is, do they start to lose credibility if they keep announcing 400,000 barrel a day increases every month and yet are only able to meet half of them, or only willing to meet half of them, when those that have the capacity are not willing to jump in and fill in the gap? I wonder when does that become a challenge for the market, believing OPEC, which has been such a pillar of the market over the last year and a half. Something to think about. Maliha, thank you very much for your time today. Great to see you again. And Christoph, as always, thank you so much for anchoring Sunday morning.
Thank you, Sean.
Apologies for the technical gremlins, but thanks to all sorts of gadgets we have in our pockets these days. We like the Russians and the Chinese. We could probably do this from the moon. All the best. Have a great week. 10:30 every morning. We will be here. Cheers.
Bye-bye.